Welcome to the Deeper Dive, the show that unpacks the why behind the market's what. I'm your host, Alex.
And I'm Christine. Ben couldn't join us today, so I'm filling in for him. It's great to be with you as we try to make sense of what has to be one of the most convulsive and revealing ends to a trading year
Yeah,
in recent memory.
convulsive is the right word, Christine. I mean, here we are in what's supposed to be a sleepy, low-volume holiday week,
Yeah.
and we're watching the Dow, the S&P 500, and the NASDAQ all extend a multi-day slide. It feels like the Santa Claus rally got stuck in a snowbank.
It certainly did. It's been replaced by this palpable sense of anxiety. But the real story, the epicenter of this year-end earthquake, it isn't in the equity markets. It's in a place investors usually run to for safety.
Wow.
It's in the commodities pits.
The precious metals market. Unbelievable. What we have witnessed in the last 48 hours is just breathtaking. To really understand the shock, let's lay out the what for our listeners.
Let's do it. So you have to picture the scene. Silver has been on an absolutely unbelievable tear all year,
Wow.
soaring a staggering 168%. Now, just for context, the S&P 500 has had a great year, up a very healthy 17%.
Right.
So silver has outperformed the stock market by a factor of 10.
Incredible. So on Monday morning, it hits an all-time record high, just over $83 an ounce.
Yeah,
The champagne corks are popping, and then
right.
it's as if a trap door opened beneath the entire market. In a matter of hours, it plummets 16%.
A 16% drop in a single day.
Unbelievable.
That's its largest one-day plunge in nearly 5 years. And gold, which had its own spectacular 66% run-up to a record above $4,500 an ounce,
Wow.
got dragged right down into that same vortex. Monday was an absolute bloodbath for the metals.
So this is where we do our deeper dive. The immediate catalyst, the thing that lit the fuse,
Right.
was a very technical, almost mechanical move from the exchange itself. This wasn't some political headline or an economic data point.
Exactly. The first domino was pushed by the CME Group, which is the main exchange where these futures contracts trade. They announced they were increasing margin requirements.
Right, and it's crucial to understand what that means. Let's translate that. In simple terms, the CME made it more expensive for traders to hold their bets on silver and gold.
Yeah.
Think of it this way. If you were a trader using leverage, borrowed money, to speculate on prices going even higher,
Right.
the casino just walked up to your table and said, to stay in this game, you need to put a lot more of your own cash down on the felt right now.
And that's the absolute key. When you've been surfing a 168% parabolic wave,
Yeah,
that move is a deafening alarm bell. For thousands of those highly leveraged traders, the reaction was instantaneous and predictable.
right.
Forget putting more money in, I'm cashing out my winnings. That triggered a frantic, forced wave of selling.
It's a classic leverage-fueled unwind. The initial profit-taking forces prices down, which then trigger automated sell orders and more margin calls for other traders. The selling begets more selling. But Christine, that only explains the how, the why this happened with such incredible violence,
Yeah.
is because the market was just so ripe for it. The amount of speculative froth that had built up was simply immense.
That's right. The latecomers to the party were all crowded near the exit. But then, Alex, comes the next fascinating chapter of the story.
Okay.
On Tuesday, after that historic crash, silver comes roaring back.
Okay.
It rallies more than 7%. That isn't the sign of a dead or broken market, no. That tells a completely different and equally important story.
So it's a tale of two distinct armies of investors. Monday's crash was the army of speculators and short-term momentum traders all sprinting for the same narrow exit.
Right.
But Tuesday's powerful rebound, that was the other army.
Yeah?
That was the army of long-term believers, the fundamental holders. They saw a 16% one-day for sale sign on an asset they believe in for the next 5 or 10 years.
They're the ones looking past the daily noise. They see a weakening dollar, seemingly endless government spending, stubbornly persistent inflation,
Right.
and rising geopolitical risks like conflicts like Russia-Ukraine. For them, Monday's crash wasn't a warning sign to get out.
No.
They saw it as a gift-wrapped generational buying opportunity. What we're seeing is a violent tug of war between these two completely different investor philosophies playing out in real time.
And this brings us to the critical link for everyone, not just commodity traders. This chaos, it's not happening in a vacuum. The reason the Dow and the S&P 500 are selling off this week is because the asset that is supposed to be the ultimate safe haven
Yeah.
just proved it can be as volatile and unpredictable as a meme stock.
That is the perfect way to articulate the problem. For the last year, the logic for big money managers was simple and time-tested. If you're worried about the economy, if you're concerned about the stability of the system, you buy gold and silver as your portfolio's insurance policy. But what do you do when your fire insurance policy suddenly proves that it's also flammable?
It creates this deeply unsettling nowhere-to-hide mentality that just ripples across all markets. I mean, if your primary hedge against risk can evaporate by 16% in a single trading session,
Wow.
where can you possibly put your money for genuine safety? That profound uncertainty is forcing investors to just sell assets, stocks, bonds, everything, and retreat to the sidelines in cash.
And this crisis of confidence is happening just as we get a look inside the cockpit at the Federal Reserve. The minutes from the December FOMC meeting were released, and they confirmed the market's deepest fears about policy uncertainty.
The decision to cut rates wasn't a confident, unified action to guide the economy.
No even close. It was a deeply divided 9-3 vote. Now, to be clear, that is the highest number of dissenters on a major Fed policy decision in over 6 years. A significant portion of the committee did not want to cut rates at all. They are clearly worried that the fight against inflation is far from the end.
So let's pull all of these threads together.
Okay.
You have the pilots of the economy publicly arguing amongst themselves about which way to fly the plane. You have the market's traditional safe haven asset behaving like a wild speculative frenzy.
Yeah.
And at the very same time, the stock market's leadership, which has been so narrowly concentrated in a handful of mega-cap AI stocks, is beginning to show serious cracks.
It's a simultaneous breakdown of all the market's core assumptions. The wild volatility in metals was the warning flare. It was the canary in the coal mine.
Right.
Signaling that the speculative fever that defined so much of 2025 was finally breaking. And now, the broader stock market is catching that same chill.
Yeah.
The Santa Claus rally has been replaced by a cold, hard dose of reality just as we head into 2026.
It really does paint an unnerving picture for the year ahead. All the easy trades, the one-way bets on AI or on gold, they all seem to be over. The market is being forced to confront real, unhedged risk again, perhaps for the first time in a long time.
And that brings us, as always, to the question we want to leave our listeners with.
Let's hear it.
Now, here's a question we'd like you to think about. For decades, investors have used precious metals as both a barometer for fear and a hedge against it. When that barometer breaks and the hedge itself becomes a primary source of volatility, is this a sign that the market is finally being forced to price in the real underlying risks in the economy without a safety net? Or is it simply the chaotic final act of one speculative bubble
Right.
before the market frantically searches for the next one to inflate?